Hello Investor Janta, welcome back. In the previous video, we discussed the relationship between price change, PE change, and earnings change. It is recommended to watch that video if you have not watched it already. The link is in the description. There, we have understood that price appreciation comes via two routes, either through PE re-rating or through earning growth, or both. We have also observed that finding earnings growth triggers may be little difficult for an investor who does not have time, knowledge and skills to do the company and industry analysis. These types of investors can be called know-nothing investors. In this video, we will discuss how a know-nothing investor can do the investment by himself. For them, the best option is an investment in index funds. What are index funds? Before understanding index funds, let's understand what is index. An index comprises the weighted average of some particular stocks as per the size or sector or theme. For example, in USA, Dow Jones Index comprises the 30 largest companies listed on the New York Stock Exchange. Similarly, in India, Nifty 50 Index is comprised of the top 50 companies of India, and the Sensex comprises of top 30 companies of India. So, we can say that the index, like Nifty 50 and Sensex, is a proxy for the whole economy of India. Similar to the Nifty 50 or Sensex, there are other indices that comprise companies working in a particular sector of the economy. For instance, there is the Bank Nifty Index which comprises the top banks of India. Further, there are market indices as per the size of companies like small cap, mid cap, etc. Here, we can see the list of important indices. However, in this video, we will focus only on the Nifty 50 or Sensex indices and discuss how for a know-nothing investor it is a good investment tool. After understanding what is index, we can easily understand what is an index fund. It is a portfolio of stocks that mimic the composition or performance of a financial market index. For instance, the Nifty 50 index fund mimics the composition and performance of the Nifty 50 index. By investing in Nifty 50 or Sensex index fund, a know-nothing investor can invest in country's top companies which contribute to the majority of the country's earnings. Now the question should come why the company or industry analysis is not required while investing in an index fund, as is required while doing investment in an individual company. It is because while doing investment in an index fund we are investing in a pool of companies. And over time good performing companies will automatically become part of the index and bad performing companies will get out of the index. Let's see Sensex companies over the years to get the idea. Here is the list of companies that were part of Sensex in 1986. Also, you can see the companies that are now part of Sensex in July 2022. It can be observed that only 6 companies continue to be part of Sensex and all other companies are replaced. Companies that continued like Reliance Industries, ITC, L&T etc. are highlighted in yellow. Replaced companies were either not performing well or other companies with better performance have taken their place. Similarly, in Nifty 50 only 12 companies continue to be part of Nifty 50 since its inception. Some names are Reliance Industries, HDFC Bank, ICICI etc. Because of this churning of the index has the highest weightage of the companies in the best performing sectors. As shown here how the industry weightage of various sectors is changed over time in Nifty 50. For instance, financial services, which were just 20% of Nifty 50 in 2005, constitute more than one-third of the whole index in 2021. Similarly, the IT sector, which was not part of the index in 1995, is having second highest weightage in Nifty 50 presently. Further, companies will get weightage in the index as per their size. Presently, Reliance Industries is the biggest company in terms of market cap, so it has the highest weightage of 11.69%. If one invests in Nifty 50, his money will be invested in the same proportion as the weightage of the company. That means today if someone invests in a Nifty 50 index fund, his 11.69% of the money will be invested in Reliance. So, it can be said that by doing investment in an index fund, money will be automatically invested in the best companies as per their size. It should be emphasized that all this is happening without doing any company and industry analysis. We know that for price appreciation, earning growth is required. So, the next question should be why earning growth will happen in companies comprised in Nifty 50 or Sensex 30. It is because, if a country's GDP grows then company's production must increase. As the company's production increases, subsequently, the earnings of companies will increase. If earnings increase then the price will increase sooner or later. In this argument, underlying assumption is that the GDP of the country will increase and that too in a capitalist economy. This assumption is true for most countries including India. Why this assumption is required, we will discuss in some other video of economics. So, till now we have understood that investing in an index fund escape us from doing industry, company, and management analysis. Now let's look at the historical performance of the Nifty 50. This should act as evidence of why an index fund is good. Since 30th June 1999, the Nifty 50 index fund has given annualized returns of 14.2% CAGR. To put things under perspective, we can say that 1 lakh rupees investment in Nifty 50 on 30th June 1999 will be around 19 lakh rupees in 2021, that is 19 times in 22 years. To illustrate further, if one invests the same amount in gold at the same time for the same duration, he will be having 34% less value. This return of 14.2% by Nifty 50 is better than many active mutual funds. We will compare passive index fund investing and active mutual fund investing in detail in some other video. But it must be said that the return from investment in a Nifty 50 index fund, which does not require any time and knowledge, will beat the many active mutual funds, which charge hefty amounts as fees. Further, returns from investment in index fund can be increased substantially by using some trend-following tools and by investing in bond market. This activity takes hardly 10 minutes per week. We will discuss this time-tested strategy in some other video. We have understood that investing in an index fund is efficient. Now the question comes: times when should one invest in an index fund? As we have understood in an earlier video, to have price appreciation we need to have either PE re-rating or earning growth or both. With that, we can say that the best time to invest in an index fund is when PE is small and earnings growth is low. As sooner or later PE will approach to mean, which is around 21. When this happens, we will get PE re-rating. And when earning growth is low, then sooner or later earning will approach at least the target GDP growth. Conversely, the worst time to invest in an index fund is when both PE and earnings growth is high. Let's understand this with an example. For instance, in the last week of March 2020, the PE of Nifty 50 was around 17 and the earnings growth was around 8%. While historically average PE is around 21 and historical average earnings growth is around 15% and the average nominal GDP growth is around 12%. So, it was a good time to invest in Nifty 50 at that time because both PE and earnings growth was low. Further, in the last week of October 2021, the PE of Nifty 50 was around 27 and the earnings growth was around 94%. So, this was the worst time to invest in Nifty 50. It should be emphasized here that the theory of PE reversal back to mean and earnings growth approaching to GDP growth is valid only to the broad market index like Nifty 50 or Sensex. It is not valid for individual companies or sector-specific index. There we have to approach differently while investing. Coming back to investment in index funds, does that mean one has to wait to fall in PE and earnings growth before investment? The answer is both yes and no depending upon the corpus of fund one wants to invest. We have explained it in one of our earlier videos, let me repeat it here. If one wants to invest a big corpus of the fund in one go, he should wait for an appropriate opportunity to invest which comes with lower PE and lower earnings growth. On the other hand, if one is planning to invest regularly for a long period of time, then he should take the route of a systematic investment plan, SIP. We will discuss the SIP route in detail in some other video and also see how the SIP route removes the need of waiting in the market and timing the market. To summarize, price appreciation comes from PE re-rating and earnings growth. For a know-nothing investor, it is not easy to identify the individual company where both PE re-rating and earnings growth can be achieved. So, one who doesn't want to or doesn't have time to analyze companies and industries should invest in broad index fund. And the best time to invest in an index fund is when both PE and earnings growth are at their low level. Hope this video helped. Thanks for watching. If you have learned something new, please share and like this video and subscribe for more.